Thank you so much for tuning into Morning Markets. I'm Amber Canwar. We have been unpacking the latest Bank of Canada rate decision that kept rates on hold at 5%, signaling that maybe rates are now in restrictive enough territory as excess demand comes out of the economy. We did see the Canadian dollar, and it has been trading up for much of the session. For some perspective on the loonie, let's bring in Bipan, Global Head of FX Strategy at CIBC Capital Markets, and Earl Davis of BMO still with me. And I see, Bipan, you are out there representing. You're got the 39th annual Miracle Day, where all the trading fees goes to charity that supports children. So we are glad to be part of that with you. I mentioned the Canadian dollar is trading up, but I actually want to look at it on a bit of a longer term perspective, because the Canadian dollar is down pretty significantly from its peak a few years ago, even with rate hikes, even with rising oil prices. What has kept a lid on the loonie?
Well, in the near term, especially over the last little while, we've seen signs of growing divergence between the bank and the Federal Reserve south of the border. And we think that could grow potentially over the next couple of quarters. And that could take the Canadian dollar weaker even still from here, especially considering what we took away from the Bank Canada statement and the notable change in the last paragraph with the bank removing the sentence referring to the fact that there was concern about the lack of direct progress on inflation. To us, that suggests that gap could grow between the Bank Canada and the Fed. And to us, that also potential to weaker loonie from here on out as well.
I want to understand what you're saying. It sounded like you were saying there's more weakness that could be in store for the Canadian dollar. What levels are you looking at?
So we've got an end-of-year forecast for dollar Canada moving up towards the 139 mark. And then beyond there, we have the loonie weakening even further, meaning dollar Canada moving higher towards the 142 mark. So those are the levels that we're comfortable running with at this point right now.
All right, so a little bit weaker than here, the way we express it, around 71 cents U.S. Now, this has not been happening on its own. Of course, this comes at a time where we are seeing a U.S. dollar strength. Does that mean, U.S. dollar weakness? Does that mean you think that the U.S. dollar could start to perk up?
Absolutely, especially considering what we're seeing priced into the short-term interest rates markets with respect to SOFR futures, still probably being a little bit too aggressive when it comes to Fed rate cuts for next year, and also the proximity towards Fed rate cuts. For instance, we see the first Fed rate cut being priced into the market happening sometime in March or April. We just don't think that's consistent with fundamentals on the ground in the United States. So we're comfortable pushing that call back, potentially seeing that first Fed rate cut coming in Q3, and maybe only seeing 2 cuts next year from the Federal Reserve. Compared to what the market is expecting, we're definitely on the more hawkish side of that spectrum. And in our view, a correction in market pricing should also equate to U.S. dollar strengthening against most other currencies, including the Canadian dollar.
Earl, as we talk about the fundamentals here that Bipan alluded to, in the break when I was talking about that Canadian dollar weakness, you mentioned there's also the divergence when it comes to economic performance, Canada versus U.S.
Yes, there is. And I'll take a step back, because in a previous life, I used to have not only fixed income, but currencies at a pension plan here in Canada. And what we would look at in regards to the Canadian dollar and the aspect of forecasting it is we found there's 3 regimes with the Canadian dollar. One is a non-inflationary regime, one is declining inflation, one's increasing inflation. If you look at these regimes, they typically last 10 years. The currency has particular behaviors within that. So one of the things that we're looking at now, we believe we're in a commodity inflationary regime, even though there's a pullback, but which will be underlying supportive. So maybe I don't see it going as high as 142, but I could see the 139. But what's interesting now, we believe that dollar, which could push it to 139, similar to what Bipan said in regards to the U.S. economy. I'm not just looking at rates, but we see the U.S. economy as being much more resilient and having divergence to the Canadian economy because of the fiscal impulse alone. So that's kind of how we're looking at it right now.
Bipan, I see you nodding along.
Yep. Yeah, no, I agree with pretty much everything Earl said there. With respect to us being a little bit on the weaker end of the Canadian dollar spectrum, but you look at the U.S. economy, it's just much more equipped, especially from a real activity perspective, to deal with higher interest rates. And we think that's a function of 2 things. Firstly, it's the starting point of household debt. As we get to this phase in which central banks are assessing data as it comes in. And the second thing is really the structure of the mortgage market in the United States compared to Canada. I mean, the U.S. is one of the few developed market economies in the world where one can get a 30-year fixed-rate mortgage. And guess what? Over the past 4 or 5 years, a lot of households took advantage of that. That's a huge safety blanket in terms of higher interest rates for longer. And, if it does come to that, and you take both of those into consideration, in our view, it makes sense to us that the Bank of Canada is going to cut before the Federal Reserve. It might even be the first central bank in the developed markets to start cutting rates in general. We're expecting the first to come Q2 of next year, which probably will be around the April meeting. But, from then on out, we still expect other central banks to follow suit. The Fed is probably going to be the last to react.
Bipan, thanks so much for that perspective. That's Bipan Rai joining us from CIBC on Miracle Day, and we are going to be continuing to cover CIBC Miracle Day a little bit later on the show. We'll speak to Roman Dubček, who is the vice chair of CIBC Capital Markets. That's coming at around 11:40 a.m. Eastern Time. Earl, it's interesting what Bipan said about the Bank of Canada maybe being the first to do something, because Bank of Canada is often the first to do something, right? They were the first to pause. They were ahead of the curve, or at least ahead of the others in terms of hiking.
Yeah, and we fully agree with that. We think the data shows that, Canada, there's two things with Canada. One is the data is turning much more quickly. We see it in our GDP numbers. We're seeing it in our employment numbers. And the other thing, which is as important, is we just have a significantly higher debt load. So in regards to the impact of higher interest rates, it has more impact on the consumer in Canada than the U.S., which says, Canada is most likely to ease first.
Okay.